This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So this chapter deals with strategy formulation, different sorts of strategy, how we can maybe close what are called profit gaps, and also how we can evaluate a strategy. It starts with what is known as Porter's generic strategies. This is almost certainly familiar to you. And Porter says that if you're going to make sustainable profits, have sustainable competitive advantage, then you must adopt one of very few strategies. So if we start in the middle here, this person who is described as being stuck in the middle, this person is not making good profits because this person is, this company is selling very ordinary products, not inferior, just very ordinary products into a competitive marketplace. Their costs are quite high, and so they're being squeezed. They're stuck between low selling price and kind of high costs. They're kind of clinging on with the tips of their fingers there. They haven't really got enough money to research and promote new products and so on there. Their life is probably going to be a bit nasty and short. If you're going to make new, better profits, Porter says there are two ways of doing it. First of all, you can lower your costs. So this is what's happening here in the cost leader. And a cost leader would strictly be the lowest cost producer around. And to get to that position, you have to have ferocious cost control. You have to make great use of economies of scale. Most cost leaders are large multinational companies with great buying power and so on. And there we are opening up the profit margin by reducing our costs, still selling the ordinary product. The other way is to increase your selling price. And if you're going to increase your selling price, you must say, I'm not selling the ordinary product. I'm selling a different product, a better product, by which you mean with better, not necessarily better quality, although it could be, but maybe better style, but in general one that the customer prefers more and therefore is willing to pay a higher price. So they're opening the margin by bringing up the selling price. They are differentiators. They have to spend more money, I suppose, innovating, making sure that they're pleasing their customers, rather than a cost leader who is all out for trying to save costs. Strictly, there's another decision that has to be made, which is a focus strategy. And a focus strategy means that instead of supplying lots of products, lots of segments, you're going to focus or specialize in a small segment and just serve that. Maybe you're a small company and haven't got the resources to serve the whole market. And strictly, you can become a focus cost leader, or you can become a focus differentiator. That only always seems more logical to me if you become a focus differentiator. Because if you're just focusing on one little niche, one little specialty part of the market, then you're going to look after it really well. You're going to provide it with products and services which suit it really well, and which is going to pay more for. If you're going to be a cost leader, by and large, you have to be a very large company. It's going to be very hard for a small family company to get to the kind of economies of scale, if you like, which are possible and which are needed if you're going to be a cost leader. These tend to be only possible if you're operating in a very big way, high automation, research and developing, money spent spread over millions of units and so on. The small family type company is more likely to have a home, if you like, or a way of surviving if it becomes a differentiator. Indeed, the large companies may not look after some of these small niches, some of these small segments of the market. The large companies are looking for the mass market. And where small companies can find a home to survive in, really, is by finding a little segment which isn't very well served by the big boys and making it products or giving it services which are just right for that, and they can make a very good long-term living doing that. Ansell's matrix is then the next step here. This is really looking at how we can increase profits. And surprisingly, on this diagram, everything that you can do is set out. So you can stay with your present products and you can stay with your present market. And how you can increase profit? Well, you can go for efficiency gains, you can save costs, in other words. You can go for penetration, so instead of having maybe 20% of the market, you look for 22% of it. You can consolidate, you can merge with a competitor perhaps, gain some efficiencies. Or maybe you decide to withdraw from a market, either because it actually makes a loss or it's more bother than it's worth. And we did talk when we're looking at customer analysis, customer portfolio analysis, on customer profitability analysis, that there may be some customers who seem to make a profit, but by the time you bring in all the costs of kind of looking after them and dealing with them and so on, you're not making very much out of them at all. So you might actually decide to withdraw from that market and concentrate your resources on more lucrative, more profitable markets. Now in this top quadrant here, this top left-hand quadrant here, it's generally low risk, low return. You're not going to be doubling profits anyway here. You're not going to kind of double your market share from 20% to 40% easily because the competitors will retaliate. You're not going to say kind of half your costs by efficiency gains. So this tends to be low risk, low return, worth going for, but not earth-shattering. The next ones we could look at is product development and market development. So market development would be, let's say we're working in Europe at the moment, that's our market, and we think, should we work in the US? It could obviously easily double our turnover, double our profits and so on. There is more risk, however, because just because a formula works well in Europe doesn't mean, let's say it's a retailing formula, doesn't mean that this retailing outlets are going to be popular in America. And there have been quite a number of very successful European retailers who tried to open in America and found it's actually very difficult. There seems to be something very subtle about the American retail market that Europeans don't quite understand right. They don't get it quite right. So you could have risk in there. You spend a lot of money trying to get into the foreign market and it doesn't work. Similarly with product development, you spend a lot of money developing a new product. So let's say your current product is vacuum cleaners and you've saturated the market in vacuum cleaners. You decide to bring out washing machines. There is a danger that just because you've been successful with your vacuum cleaners, you're not going to be successful with the washing machines. And again, you've spent a lot of money developing those. So higher risk, higher return. And then down here you have the highest risk, higher risk return quadrant. We're going into something either completely different, which is unrelated diversification, or something which is a bit different, which is related diversification. And because we're straying into areas that we know kind of nothing about or very little about, there is a much greater risk that we get it wrong. I'll be coming back to looking at diversification in a couple of slides' time. Now, Ansell's matrix can be linked to what is called gap analysis. So gap analysis works like this. Here you are, you submit your budget to head office. Your budget looks like an 8-year budget here. This is your forecast. Email it to head office, and within about 15 minutes back comes an email saying, no, this won't do at all. If you want to keep your job, this is a target you must aim for up here. And of course, what we've got in here is the gap. And we have to think how we're going to close this gap. And there are a number of different ways, really mirroring what was on the Ansell's matrix. You can have efficiency gains, cost savings, for example, market penetration and so on. Then there can be expansion gaps, new market, new products. And then finally, there is a diversification gap where we're going to do something which is radically different. So gradually, by using a number of these different methods, we can maybe bring our profits up to what head office wants, or indeed what our shareholders want. What we need to do is to find some way of evaluating our different options. So we could develop a new product, we could go into a new country, we could merge maybe with a competitor and so on. Which one of these should we do? Because we mightn't be able to do all of them. We mightn't have the resources, for example, to do all of them. And Johnson and Scholes here come out with a very simple 3-step method of trying to evaluate strategies. They say, is it suitable? So if you were thinking of expanding abroad, one of the markers of suitability would be, is the country we're thinking of going to, is the economy picking up? Or is the country we're thinking of going to, what's the competition like there? Because if the competition is fierce there already, then we're going to have trouble. So is it suitable for almost the environmental situation that we're in? Acceptable. Is it acceptable to our stakeholders? So, for example, our shareholders. Our shareholders might be shareholders because what we produce for them is very dependable dividends. We don't take any big risks, and they like us because maybe their pension depends on getting these dividends. And suddenly we diversify into something radically different. We invest a lot of the profits instead of paying dividends into this new subsidiary, and that could be very unacceptable to our shareholders. We might do something which is unacceptable to our customers. We might decide to open up call centres abroad, which customers find difficult to use. Maybe we instead of having a real presence on the high street, we go to internet only. And maybe some of our customers don't like that because they like to go and examine the goods before they buy them. It might be unacceptable to our employees. We might want to go from operating 8 hours a day to 24 hours a day, but we have to persuade our employees to do that. And of course, we're going back to looking at stakeholder analysis. What is the power? What is the interest of the stakeholders? Are they key players? To what extent do we have to work very hard to get them on side? And finally, there's feasibility. Can we do it? Do we have the money to do it? Do we have the expertise to do it? If we're thinking of opening abroad because the foreign market looks buoyant and we have no resources in-house that know anything about international marketing, then at the moment it's not feasible. And we have to put certain things in place before we can do it. Now you're going to probably get ups and downs across these 3 measures really of different policies. So you might find one strategy is suitable and acceptable, but it's not actually feasible. You might find another strategy is suitable and feasible, it's not very acceptable. And it's going to be in practice quite hard kind of comparing strategies, unless there's an outright winner which seems to hit all of these suitability, acceptability and feasibility things kind of perfectly, and all the other ones are way behind within that. But it's a very, very useful and simple way of strategy evaluation.